Pennies Going in Raw is a production of iHeartRadio. The opinions expressed in the following podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide education and entertainment about the financial industry and the stock market. Enjoy!
On this episode of Pennies Going in Raw, we discuss SPY's drop below 400, Amazon's connections, and more.
You find out life's this game of pennies.
Oh, you guys know we only have a 40% runner. Hello, 40% is a fucking killing.
We've been compliant for too long. It's time we go to war.
I don't have a Roth.
Hugh knows so much about the market that his brain doesn't have enough room for grammar.
Hey, who told me about IDEX? It's going up a shit ton now.
Rob, 4%, baby. No way. 4 fucking percent.
You asked the exact same question with 2 words different.
It's like, man, I just got dick whipped for like 20%, and now that f***er's up like 50.
I bet Warren Buffett never did that.
I'm just making this voice memo to call out unusual whales to a fight.
The pennies we need are everywhere around us.
Pennies.
Going in Raw.
Featuring Dan, Deity of Dips,
And Hugh Honey.
Produced by Vinny.
And Christian.
Let's go, baby.
Welcome back to another episode of Pennies Going in Raw. Today is Wednesday, May the 11th. We're actually recording this around noon Eastern time on May 11th. So right before we drop it, SPY's on that 400 mark. It's funny to think about. Just 3 months ago, we were saying all the things it needs that it could be at 500 again and reach over 500, but now we are so far away from that. I don't see 500 this year, unless something really good happens to you.
No, I think the Fed's aggressive raising rates, really, I mean, it goes back to the train analogy that we used, 6-7 weeks ago. Being that, is that it's a really touch and go process. And I still think that we're inside that touch and go process. It was just that like the beginning raising of rates was so touchy. And I still, like I said, I still think that we're inside a touchy area. However, that was like the first time that you step on ice on like a frozen lake, like you don't necessarily know if you're going to go through or if you're going to be okay. So
I've actually never heard that analogy, but you used it quite well. I'm impressed.
Thank you.
Yeah.
Thank you. That one I've always been I've always had inside the back of my head now for a year or two. And
just saving it for the right moment.
Yeah, saving it for the right moment. This one felt like the right moment. But yeah, like that's what it means. That in theory, there's ice on top of the water, so you should be able to climb on board. However, sometimes you step on the water and you go right, or step on the ice and you go right through. So that's the way that I kind of thought of it. And, they have aggressively raised interest rates. Now, the one thing that I did think was going to happen was that I thought that we would see a pretty big influx from Europe because the Europe markets have gotten smoked. So I thought that we would see an influx from the European markets, kind of like a flight to safety, as the U.S. equities. Now, I don't think we've seen that much. And the other reason that I don't think that we'll necessarily see 500 is because the Fed hasn't even started really reducing their balance sheet yet. And that's when I think the market could get smoked. Because again, is that the Fed has basically injected liquidity for the past 2 years, hence making the market, fly. And when I say injecting liquidity, I don't mean just into the market, I mean into the economy as well. And so, with the stimulus checks, yada, yada. And so when they start to, sell off some of those assets and they start to, shrink the balance sheet, that's when I believe that we'll see a completely different, market. Because again, the same thing for the same reason that liquidity, boosts up the market, the second that liquidity is dumped onto the market, it can do the same thing if there's no buyers to absorb that liquidity.
This week was the first time we've seen SPY under 400 in forever. It's gotten close a few times, but we saw it for the first time. Didn't really drop below 395. I mean, when it first happened in the after hours, made it to around 396, but it hasn't exactly decided where it wants to go. What was your first reaction when it happened? And was it anything of what you kind of expected? I expected to drop a little more, especially since that happened during right beside after hours. But what would you kind of think of it all?
So I did expect that we would maybe drop right underneath 400. And then the average trader, investor, whatever you want to call it, would become super bearish. And I actually thought that we would have a retest of 420 before dropping lower. You know what I mean? I thought they would be something where they bring it right underneath that psychological level and then they pump it back up and then just to drop it. So we didn't really have, once it dropped below 400, we had a move back to 406. And then, we've just kind of been between that 397 to 404 area since then. I did think that if CPI was 8% or lower, which it was, that the market would squeeze, because that would show that there's a topping inside of inflation. And typically when, and this is something that we've said a few times, is that typically when inflation is topped, that's, and it doesn't go higher consecutively, that's typically the highest point of inflation for that time period. So, when
can you repeat that last sentence one more time?
Yeah. So when inflation isn't, think of it like a chart. When inflation doesn't hit a new high for that time period, two readouts in a row, that's typically the topping point. And so similar to inflation when it on the upward swing, it's really hard to stop. Once inflation gets over, I'll call it the 4.5 to 5%. It's really hard to stop it from continuing to go higher. It usually goes on a run, and it doesn't top unless typically the Fed steps in. On the same token, on the downward swing, if it tops twice, and what I mean by tops twice, if there's no two consecutive, if there's not a consecutive high, 2 readouts in a row, then that's typically top. And from that point forward, I don't want to say it's really hard to get a new high, but that's typically the top for that time period. And the next, is that it's typically always lower after that than higher, which I think is really important.
And you wanted to touch on inflation a good bit this episode. Did you want to dive into that now, or did you want to talk about the market a little more? Because I know it's the fact there's a lot of stuff going on, even when it comes into Amazon's down 30% with one of the more bullish things coming up.
Yeah, Amazon's getting absolutely smoked right now. So that from that one share that I bought last week, so as we're reading this, which is noon Eastern time, it's down 12%.
Yeah, insane. We thought you were getting a good buy there.
Yeah, and I still think that there's good value here in most of your blue chips, and especially the indexes. The indexes, even though they're not down huge, the NASDAQ is down huge. SPY's only off 16% from highs or something like that.
480, probably 20%. Yeah.
Yeah. And so this is where, if you've been because everybody's been waiting, I feel like there's a good amount of people that sold all their stocks after COVID, once COVID hit a new high, and they've been kind of waiting to get into the market. Although the market's still significantly higher than when you sold, this is an opportunity, I think, to start to kind of scale into those long-term positions again. And what I mean by that is SPY. So I saw something where, and this is a strategy that I really like, is they're going to scale in 20% of their portfolio every 20% that SPY goes down. So for instance, right now, I think SPY is at 17% from highs. So they're going to buy some right here at 400. and then if it goes down another 20%, so that would be, what would that be? That would be like 350 or something, right? Does that check out?
One more time.
Like 400 to 350, is that another 20%?
400 to 350 is around like 12%. Yeah.
Yeah. So the next buy that they would take would be at, I'm doing the math real quick, would be at like 320. So 400 would be the first nibble, 320 would be the next, and then net down another 20% from there, et cetera, et cetera. And so at that point, you have 40% of your account in, 40% of what you want in at around like 350. So that's 100 points off SPY's high. If it goes down another 20% from there, then your average price will be like 315 or something like that. So that gives really good risk to reward, because when SPY inevitably hits all-time highs again, you're locked in at 315, let's just say 315. And so all the way back to all-time highs is over 40%. So I think that's a really good strategy to take. And I think for most people that's not a bad strategy. But again, if let's just say you buy 20% here at this 400 mark, and all of a sudden we're at all-time highs by the end of the year or something, that's a nice little 20% win. That's a nice little 20% win on that position, and you still have a nibble, or you still have like a good amount on the street, but you're still going to take home a nibble, and you still are exposed to the market. You know what I mean? So I think that's a really good strategy. I really liked hearing that. This person did that same exact thing for COVID, and obviously we saw how that worked out for them. And it's something where I think that strategy is really easy. It's timeless, and you really can't go wrong with it, because absolute worst case scenario, if the market goes down to 80%, then at 80%, maybe you're down 30%, but maybe 25, 30%. But again, is that you're just going to cost average in. And so I really like that.
Okay. Well, before we go into inflation, someone asked me this week, they were wondering, we were talking about Amazon being down, and they mentioned Rivian with it and the connection they had. So I think kind of talking about like how one company can be affected by another, and like why they're on each other's earnings reports, and how much overall that would affect them. So could you kind of dive in on that a little bit?
Yeah. So just a little bit of background is that Amazon in 2019 bought an 18% stake in Rivian. So when Rivian was, pumping towards like a $10 billion market cap, that was a pretty nice little payday that Amazon had. Because again, is that they had invested and bought 18% of Rivian at that 2019. So even like right now, like Rivian's at like a $20 billion market cap. So $4 billion of that goes to Amazon. So basically 9 months ago, when Rivian was at around that 179 area, Amazon's stake was worth like 30 billion. So now that Rivian has gone from like 179 to the low 20s, again, think of it like an unrealized gain on like a stock. When it's going well, you're thinking that this was a fantastic investment and you're a genius, blah, blah. And now you see like, let's just call it like 100,000 in your account. And then the stock drops by 80%. And now that 100,000 is down to 20,000. And so even if you're still up a little bit on your overall, even if you're up a little bit on your overall position, you're down big inside the short term. And that's what Amazon was seeing inside the last earnings report. Its investment in, so I'm reading this from Fool.com. It sounds reliable. Its investment in the EV maker was responsible for 82% of the fourth quarter net income, or the net loss, really. And so that's really quite concerning. But again, is that I think it's one of those things where I think it's one of those things where, okay, Amazon got it out of the way this quarter. Like now their investment isn't that big. Like they lost like billions and billions inside quarter 4 on this investment. Now they can't do that because the entire company is worth less than what their stake was, 9 months ago. 9 months ago their stake was 30 billion. Now the company is not even worth that. So I think that that's really important to think about, and I think that Amazon should probably scaled out some and taken some profits up there. They seem like smart people over there, but they didn't, and that's okay. And they probably knew that this was coming. And honestly, I wouldn't be shocked if
can Amazon have like an investment? So they have like accounting, and then they just have an investing section where they just have someone day trade like all their investments.
That's literally what it feels like sometimes with them, because it's like every new sector, it feels like they're like getting into at some point. But yeah, so that's what I mean is that Amazon, like near this 2,000 handle, I'm totally okay, especially with the split coming up. You have 2 weeks left to buy before the split. I'm gonna double my position in it, and I think that's one of those things where it's totally okay to buy some Amazon down here, Disney down here. Those are like the only individual stocks that I think that I own that I would be okay with, telling like my grandpa to buy, because those are ones where, they've gotten smoked. Amazon is literally down inside the past month. It's down, it was over 3,000, and now it's about to go under 2,000. So I'm totally okay if you want to, if you ask me if you want to buy some Amazon, I would feel okay with that, because it's down here. That earnings report was terrible. However, their actual earnings report for Amazon really wasn't that bad. It was just a massive net loss, again, because of the Rivian loss.
Okay, so that is a perfect example. And do a lot of companies do that, like where they just can have such a big investment that it makes them look bad because of it?
No. I mean, listen, at the end of the day, but see, this is also how their so their Q4 for Amazon. So let me pull up the article again. From the fool.com, that's what they were saying was that in quarter 4 of 2021, the Rivian investment was responsible for 82% of their net income. So, but that was one of those times where it really worked in their benefit, because on paper in Q4 they probably made probably 15 billion on the Rivian investment, and now that's just gotten smoked. So it can work with you or against you. However, I will say that Rivian inside, and that's what happened with this big EV bubble, which Tesla led the charge for the last few years, was that they all had these crazy valuations because it's the future, and and the government was behind it and all that. And so like the past year, like Rivian's down 78%, which is just wild. And I mean, it hit 172. And the other thing with Rivian is that I don't necessarily agree with, but they gave people that were fans of the car company shares at $80 a share. And so that valuation alone is ridiculous. That valuation was almost 100 billion. Somewhere around like the 80 billion mark. So, and again, is that they have like literally no revenue. So that's one of those things where it's like, that just didn't make sense. They did in December 2021, they did 54 million in revenue. Their net income was negative 2.4 billion. So it doesn't make sense. This was a big EV bubble, I think. And I'm not saying that Rivian can't be a $20-30 billion car company. It's just those valuations were so stupid. They had no revenue, and they were trading at they were trading at 200 billion market cap, which made no sense.
Okay, so diving into our next topic, it's been a big one as of late. You wanted to touch on You want to touch on inflation again. I know you just explained how it can peak. Are you saying we're near the peak? I know that would probably make a lot of people happy.
Okay, so first I think that we should just talk about just because we'll talk about price increases over the last year, and then we'll talk about this month's CPI report. So over the last year, gas is this is wild. Gas is up 43%. Used cars are up 22%. Gas utilities up 22%. Meat, fish, and eggs up 14%. New cars up 13%. Electricity up 11%. Food at home up 10%. Transportation up over 8.5%. Overall CPI up 8.3%. Food away from home 7.2%. Apparel 5%. Shelter 5.1%. So what we're seeing is, I mean, most of them are double digit gains, and I mean, you even have gasoline obviously up 43% is massive, but used cars up 22%, and even our food is up about 15%. That is ridiculous, and obviously the Fed needed to do something. About this. But the issue that I think why the market didn't squeeze on the CPI report was because although inflation slowed, the Fed Reserve came out and said that for them to change the current plan, they would need the inflation to really slow down. And so I think this just goes back to show that, when they originally made the plan back in March, that they had said that they had wanted inflation to 3.5-4% by the end of the year. Well, we're almost halfway through the year and we're still at 8%. So it shows that although the situation's not getting worse, it's not necessarily getting any better. For us to hit the numbers that they quote unquote set, I mean, we would need to really kick this inflation in the ass, and we would have to reduce a percentage point. Inflation would have to go down about 11% a month for the next 6 months for us to see that Federal Reserve target price. So I think that's why maybe the market's not rallying super hard off of this. The other thing is that we still are tiptoeing around a recession. The Federal Reserve, if they come out too hawkish, in any of these meetings, I mean, they definitely could send us into a recession, which nobody wants that. That's not good for anybody.
All right, well, kind of diving into our last topic, something that was working great for about a year and a half, but you just are not seeing anyone really perfect it. Maybe some options guys right now, but Twitter calls. Is this the death of social media calls? I mean, every single one is just going terrible. I mean, people are calling them, but nothing's working. Obviously in a bearish market, I mean, you can call puts. I mean, you see people like Manziel and people in his room actually making quite a good bid off of it. But anyone calling longs right now just doesn't seem to be making things happen. What do you think of this? And do you think the future of Twitter calls entails?
I still think that FinTwit's going to be big. I don't think that'll necessarily ever go away. But I think that there were so many chefs. I mean, that was part of the reason that I stopped posting a lot, or, I stopped posting as much, was because they just felt like too many cooks in the kitchen. Everybody and their mother had an opinion, and every opinion was wrong if it wasn't your opinion. And it just didn't become a super fun place. And so I think that what we've seen lately is just a massive wipeout of traders. And I think that a lot of them are the ones where, you have a good year and a half, 2 years, you think you're the boy. And then all of a sudden, you're getting smoked. And so I think that that's kind of what we needed, was that we needed not a great wipeout, but we need like everybody to get a little humbled, and I mean everybody across the board, 401k investors, day traders, swing traders, everybody. And so I don't think that FinTwit goes away. I just think that we saw this massive amount of growth. And I think that we saw this massive amount of growth. And from this point forward, what we're going to see is that we're going to see, we've obviously seen people leave FinTwit. You know what I mean? Like, just even like, like work from home people, like everybody. And now I think that we will start to see, just again, is that it kind of goes back to that 2017, 2018, where it's like truly traders are on FinTwit, and maybe there's like a few people work from home that are also on it,
Yeah, we'll see. We will see as it goes. But no, I know we talk about this every now and then, but for the people that were always taking the Twitter calls and who it always worked for, what do you recommend in this market if you're going to transition into being your own trader? I mean, I know we went over it whenever the market was so choppy. If you wanted to practice options with the one at a time or day trading SPY, things like that. But what do you think now is the best approach for coming into your own trader?
I think the biggest thing is learning risk management. Like that's what I see a lot of people really struggle with recently is struggling with the risk management part of all of this. And I get it. Like that is really tough. However, that's going to be the thing that really sets people apart. Like right now, it's not really, in my opinion, about making money to compound your account. I see the market right now as, just survive, like that's really what I look for is like,
wait for just that crash.
Yeah. Like just survive right now. Like your opportunities will come, but just survive this kind of market. And then from there, pick up the pieces, like that's truly what I think is the way to handle this right now, because everybody else is kind of blown up. So don't be that person,
Yeah, no, you want to be the one on FinTwit in a year still. Because I mean, you think about all the faces that were on FinTwit just a year ago. Man, I miss them. Just thinking about like the Mo Monies and like the funny ass shit that used to be. I don't even know. We were talking about him. Like, what the fuck happened to him?
Yeah, like there's so many people where it's like, holy shit, like that. We used to talk to that dude all the time.
Yeah, well, come and go, I guess. But how much longer are we gonna have to wait for a real until we can just put all our money in, dude? When's the next COVID crash, dude? I think that's what we're all waiting for. So we can all just put the money back in and make all our money. We're tired of waiting though.
Yeah, no, you're right. And so I think that the biggest thing for this is that listen, I would love if the pressure kept up. I would love if this pressure kept up, like we just kind of smoke the market for the next few weeks.
No, I'm down with smoking the market for the next few weeks too, dude. I'm chilling and waiting on the sidelines, dude, better than losing money and shit.
Yeah. And so I think that, I wouldn't mind just smoking the market a little bit, because that's what we've seen. There's a lot of downward pressure. We get like 320, on SPY or something. And I mean, the market's like really inside a good position. So I think that's the situation that we need to think about, is that, just wait for the market to kind of bottom. Like, I don't think we've really seen like a distribution day. And what I mean by that is like a really high volume day where like you can effectively go long. Like I don't think we've had that day at all. And so until we have that day, just let the market do its thing. It's better to not do anything than to lose money.
Yeah, no, that's exactly what I was just saying about I'd rather be on the sidelines than be the person not here on FinTwit a year from now because I couldn't sit out and wait during a shitty market.
Exactly, because that's the biggest thing, especially like for you guys who've had some amazing 2 years, This is why we have 12 months of expenses inside our bank accounts for these exact reasons, So don't be stupid and be smart on it.
Yeah, think about like yourself 2 years ago. If he found out that you were on the verge of losing everything in like, well, sometimes I think about like if me from 2 years ago found out that I even had $100,000 of just like in a trading account, I'd be like, no way you could fucking lose that. You've got it made. So you got to think like there's no way I should even be able to lose that, especially not in a day, week, or even shitty little market cycle, you know?
Exactly. And so that's why I think like just relax, just chill out, you know, like something that I've been toying with, you know, putting out alerts again, like intraday alerts, you know, for the overall SPY market, you know, like I was doing that for a little bit on my Instagram. And so if that's something that like, you know, people like, then like maybe we'll start doing that, you know, just to maybe like a few bucks, like, you know, just really high quality setups. But overall, just chill out, take some time. And like the thing is that like, you know, like the past like 6 days, like actually, it's funny. I've had like 7 green days in a row, which I haven't done in like a year and a half. And I'm not like doing, like, I'm not like throwing up crazy numbers. But again, it's like enough to keep the lights on. And it's just really high quality setups. And that's the way to do it, I think.
All right, guys. Well, that should cover us for this episode. We hope you all enjoyed. And we'll see you on Sunday. This is the last one of our little intern's finals. And he gets to get out of his final and edit this video. So how exciting for him, you know, back in college.
Sounds like fun.
Yeah, no, after I got done with my finals, that was probably the same shit I would have been doing. So, all right, guys, we will talk to you later, and TTYL.
Pennies Going in Raw is a production of iHeartRadio. For more podcasts from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts.